Have you ever gone out of your way to do something thinking you were being responsible, only to find out later, sometimes much later, that the exact opposite was true? Sometimes you never found out at all, and you were fighting a losing fight all the way to the end. It's called the Quicksand effect, and it's when retirees predictably engage in the wrong actions and get the wrong outcome. Now, before we begin, I want to clear up a point that a lot of people focus in on. When you think about someone who's done the wrong things for retirement, you think about somebody who's spent all their money, lived life for today, racked up a lot of debt, and when they went into retirement, they were nose deep in problems. But that's often not the case. The ones who accidentally destroy their retirement are usually the responsible ones. They did everything right. They saved on time. They saved over many, many years. They put their money in the right investments. They did what they were told. And then when they entered retirement, they did the wrong things. A few of these traps, by the way, come out of nowhere, often buried in the tax code. And people who aren't tax experts, in some of these anyway, have some options where they could make life much better for themselves, and they don't follow through on those options because they don't know how. So today, I'll show you 10 ways that people do this and how to sidestep each one. Watch the thread that ties them together because it points to the fix. All right, let's start with number one. This is the one that most people are proud of, being proud of a zero tax bill in your 60s. Let me explain. People going into retirement can manage their tax bill by withdrawing less. And a lot of people will brag about the fact that they had a zero tax year. But in many cases, that might be short-sighted. The money in your traditional IRA or 401k has never been taxed, but the IRS will not wait forever. They have something called a required minimum distribution, and it happens at age 73 or 75 for most people watching this video. And once the RMDs begin, you need to take money out whether you want to or not. If you spend your 60s letting that account grow, those forced RMDs will land right on top of your Social Security payment, right on top of a pension if you have a pension, and other fixed income that comes in. This puts you in a higher tax bracket, at least potentially, than you would have been if you had had a smaller amount in that 401k or that IRA. The fix is that you think about your taxes across your entire retirement, not just in the upcoming year or two. In the low-income gap years, those are the years between when you retire and the RMDs begin, it might make sense under a lot of circumstances to take money out when you can fill lower tax brackets. You can do it a number of ways. One of the most common is to convert those funds into a Roth, and then they are tax-free for the rest of your life. In other words, you pay a little now in order to avoid a lot later. Number two is so sneaky it has a name. It's called the Social Security Tax Torpedo. Depending on your income, part of your Social Security payment is taxable and part of it is not. The dividing lines, $32,000 and $44,000 of what the IRS calls combined income for a married couple, were set back in 1983 and 1993, and they've never been once adjusted for inflation, so more retirees cross them every single year. And here's where people don't usually connect the dots. One extra dollar from your IRA isn't just an extra dollar. Sometimes it drags your Social Security up to 85% taxable. So it's $1.85 of taxable income, not just a dollar. For a couple in the 22% tax bracket, that can create a marginal rate of 40.7%. The fix is simple, understanding where those thresholds are so that you don't blow through them without even knowing about it. This is exactly why gap year planning from mistake number one is so important. Point number three, IRMAA, the Medicare income cliff. Here's a question most people never think about. Can earning one extra dollar cost you more than $1,000? With Medicare, it can. It's called IRMAA, and it means your Medicare premium is tied to your income. Most people pay the standard Medicare Part B premium in 2026. That's $202.90 a month. But crossing the income line, even by $1, and a surcharge is bolted onto not only your Medicare Part B premium, but your Medicare Part D premium. For a married couple, that amount is $218,000 of income. If you're single, it's $109,000 of income. Go over it by $1, and you're paying a higher Part B premium and a higher Part D premium. If you breach these thresholds, that's an extra $81 a month per person. And if you go all the way to the top, that's an extra $7,000 a year per person. Two things make it worse. It runs on a 2-year delay, so your 2026 premium is based on your 2024 tax return, and a one-time bump, a big withdrawal, a Roth conversion, or selling a house can trip it. Here's an important point. There are relief valves for this, big life events like retiring or getting a divorce, for example. But the items that I just talked about usually don't qualify you for those exemptions. So the real fix is to see the clips coming and spread your income so you don't clip one by accident. Number 4, draining your accounts in the wrong order. Now this is one that people think, this is just a technicality. Does it really apply to me? For most people it does. The order in which you take your money out of your different accounts changes the amount of tax that you pay in retirement. Most people have 3 types of accounts. They have a taxable account like a brokerage account. They have a tax-deferred account like a 401k or an IRA. And they have a tax-free account like a Roth. Most people drain one account all the way down before they move to the next one because it feels tidy. But that often creates a big tax bump right in the middle of retirement, especially when a required minimum distribution is happening. Fidelity ran the numbers on this. Blending your withdrawals to keep your income smooth instead of emptying one bucket at a time cuts lifetime taxes by more than 40% in their example and made the money last longer. So the fix is not one universal withdrawal order. It's managing your buckets in a dynamic way so that you optimize the amount of taxes you're paying at different points in time. In many cases, you'll still save the Roth for later, but not if you're hoarding it and it causes a bigger tax problem than you would have had you used part of the Roth today. Point number 5, forced early retirement. Now, everything we've talked about up until this point is something that you have control over, but a forced retirement is out of your control. You plan to work until 67, then a layoff arrives, or a health scare, or a parent or spouse needs full-time care, and suddenly you're retired at 61, years before you meant to be. This isn't rare. 6 out of 10 people leave the workforce before they wanted to, and the leading reasons are either health or a layoff. Now, if you think about it, this can devastate your plan. You expect to have a few more years of income, you're not touching your retirement accounts. In fact, you'll have a few more years of contributions to those retirement accounts. Now, all of a sudden, you need to draw from them to live. The fix is to draw your plan around an earlier than expected exit and to build a cash reserve so that when it happens, you don't have to sell assets in order to live. And know your bridge options, how to cover your health care between the time you retire and the time you qualify for Medicare at age 65. Also, how does leaving early change your view of when to take Social Security? Does it change it at all? The people who planned for this in advance have a better chance of success when something unexpected happens. Gang, if you're still using spreadsheets to manage your finances, you're doing it the old-fashioned way. The fact is, spreadsheets are prone to errors. Make a mistake in one cell and it can have a ripple effect through the entire sheet. Now, on this channel, we have 3 affiliate relationships. One is Bolden Personal Financial Planning Software. This is the personal financial planning software that I personally use. With Bolden, you can build up to 10 different scenarios and compare as many as 3 side by side to see how choices play out. You can set up withdrawal strategies. Choose among spending-based, fixed percentage, and maximum spending approaches with a customizable account withdrawal order. You can set up a must-spend and like-to-spend budget, which clarifies the connection between your fixed expenses and guaranteed retirement income. If this is of interest to you, Bolden offers 2 weeks free of their full-featured software. You can use our affiliate code to get the 2 weeks free. Simply go to go.bolden.com/Schmidt and try it free for 2 weeks. If you like it, then it's only $12 a month paid annually after the 2-week free trial. Number 6, the widow's penalty. Imagine a married couple that did everything right. Then one spouse passes away and the survivor discovers the IRS has changed the rules on them. Here's what happens. The year after a spouse passes, the survivor usually has to file a tax return as a single filer. And single filer tax brackets are far narrower than married couple tax brackets. The same dollar of income from a pension from an IRA withdrawal, or Social Security for that matter, gets taxed at a higher rate. Meanwhile, the household income doesn't fall anywhere close to half of what it was before. Less income, a higher tax bracket at the worst possible moment. That is the widow's penalty. It can even push a survivor over those Medicare cliffs that we talked about earlier. The fix is to look at different scenarios, a single filer and married filing jointly, and to do Roth conversions when you're married filing jointly if possible. Point 7, claiming Social Security in a way that shortchanges your spouse. A lot of people claim Social Security at age 62 or 63 because it feels safe, or they want to invest it, or they have a different reason. But when one spouse passes away, the survivor doesn't get both payments, the primary insurance amount and the spousal benefit. They get one payment. They get the higher of the two. So the size of the check matters enormously. It may be the one thing that the spouse lives on for years to come. When the higher earner claims early, they're not only shrinking their own primary insurance amount, but potentially the survivor benefit as well. Every year that they wait from full retirement age up to 70 adds about 8% for the rest of their life. And that bigger number carries straight through to the survivor. So the move for a married couple is to decide as a household, not as an individual, your Social Security strategy. Point 8, letting the first few years of the market run your plan. Here's a strange fact. You can take two retirees who have the exact same investments, have the exact same return on those investments, have the exact same withdrawals from their portfolio, and have two different outcomes when it comes to the success or other of their retirement income. One will run out of money early while the other has excess money at the end of retirement. The difference is the year in which they retire. And what I'm talking about specifically is, are they retiring into a bad market or into a good market? When you were working, a market crash was almost good news. Your paycheck kept buying investments, but at a lower price. In retirement, it flips. When you withdraw in retirement and a market crashes, you're withdrawing money at a lower price, and you're not going to get those shares back. Advisors call this sequence of return risk, and a bad market in your first few years of retirement can do lasting damage, even if the market fully recovers later. But fear can be just as expensive. If you keep your money in cash, you'll miss out on 20 or 30 years of growth in order to protect yourself from 4 or 5 bad years, maybe a few more. But the point is that over a long period of time, markets generally outperform a cash investment. So both extremes fail you. One simple solution is to keep a cash buffer and use that when markets have fallen and you don't want to sell shares. Number 9 is the one that nobody thinks will happen to them, and that's exactly why it happens to them. It's called fraud or a scam. In 2024, Americans age 60 or older reported losing $2.4 billion to fraud. This is roughly 4 times what it was just a few years earlier, according to the FTC. And it's not just the obvious, your grandson is in jail phone call. The category that takes the most by far, investment scams, often fake cryptocurrency deals. The nastiest version is called social proof, and it plays out on social media. Someone will make a comment about how they made 10x their investment, 5x their investment, whatever the number is, in a very short period of time, and thank you, advisor, and they'll put the name of the person out there. And so what do people do? Well, they use their search engine and they search for the name. And of course, there's only one person with that name at the end because that landing page has already been set up and it's waiting for you. Here's one solution that will slow this down, maybe even stop it completely, and it's simple. Never act on a contact that came to you, a call, a text, an email, a comment. Hang up and reach out yourself through a number or a person you already know and trust. And remember, if a stranger online is promising you a guaranteed return, the only one that's getting rich, probably anyway, is them. Gang, how prepared are you for retirement really? The average person thinks that they're more prepared than they really are. That's why I created the Retirement Readiness Quiz, 100% free. It's 15 questions, it takes about 2 minutes to fill out, and at the end you'll get a 12-page report emailed to you instantly. The report will help show you areas where you're strong and areas where you might want to spend a bit more time. If this is of interest to you, go to hollyschmidt.com/quiz, fill out the 15 questions, and get your free report. You'll also be put on our list and get tips, tricks, and other information by email a few times a week. The last one, passing away with a huge balance and a list of regrets. Most retirees think the whole game is simple. Don't run out of money. But confusing I didn't go broke with I won is one of the biggest mistakes there is. Here's what decades of watching this play out will teach you. Some careful savers spend their entire retirement worrying about running out of money, only to reach their later years with far more than they could ever use. The real failure is not running out of money, it's getting to the end with a big account balance and a list of things that they should have done, that they wanted to do, but they didn't. And here's the cruel part. The discipline that taught them how to build that fortune in the first place is the same discipline that's preventing them from spending it now. So here is how you fix it. Name your go-go years, the early, healthy, active stretch of retirement, and plan to spend more then while you can truly use it. Use a flexible spending plan with guardrails instead of a rigid rule, so you have permission to enjoy the good years. Your money was always meant to be a tool, not a trophy. If you like this video, check out that video. You'll probably never spend your retirement savings. Also, don't forget to check out Bolden. Go to go.bolden.com/Schmidt to get your 2 weeks free. This is Jeff Schmidt, and I will see you in that video right there.